Welcome to SCV Means Business, the official podcast of the Santa Clarita Valley Economic Development Corporation. Stay tuned as President and CEO Dr. Jey Wagner interviews business leaders and explores the many ways that companies connect and contribute to their community.
Hello and welcome back. I'm Jey Wagner with the Santa Clarita Valley Economic Development Corporation. It's a pleasure to be here on SCV Means Business. And of course, I'm joined again by our very favorite economist, Dr. Mark Schniepp. Mark, it's a pleasure to have you back.
It's good to talk to you again, and it's good to update what's going on in the economy right now.
Well, we are definitely looking forward to it. There's so much I'm anxious to talk to you about. Last time we were together a few months back, you took us from the macro to the micro. You gave us a quick insight into what could have been considered inflation, but you had mentioned we actually were touching on the point of deflation. Big picture wise, I wonder if you wouldn't mind at least opening up for us on your comments as far as how we are doing as far as heading in the direction of positive deflation, or did we get to the point to where we're going to be in danger of inflation?
Since last time, we kind of hit a floor, and and I think everybody kind of knows this, but just to put this in context, for about the last 6 months, we haven't really made any progress on inflation. The deflationary trend kind of abruptly stopped, and we're just sort of hanging in there at about 3.5% rate of inflation right now. It's better than where we were, but we thought we would be making consistent and steady progress. That hasn't been the case. So this has raised concerns among the Federal Reserve, of course, who was in this highly restrictive monetary policy mode to get inflation extinguished. And then they shut that off. And since shutting that off, essentially, we really haven't succeeded in getting to their target rate, which is 2%. We're still, again, floundering around 3 to 4%. So that's kind of the latest news on the inflation front.
Gotcha. It appears there's no expected interest rate cuts during the rest of the year. I think that's safe to assume, unless you've heard otherwise. But it just seems like maybe there's the assumption that the interest rates could be high enough to beat inflation. What are your thoughts on
that? The Fed had announced back in December that they were looking at cuts this year. In fact, and then the stock market started to rally big time. And so it went up to all-time record highs in the first quarter. It's still quite high. I mean, it's still challenging some of those at times. But now with the inflation reports not cooperating, essentially, this is going to postpone the ability of the Fed to ease up on monetary policy, because they don't want to reignite inflation above where it already is. So we're not looking at cuts at all this quarter, and probably not going into the summer. We probably see the first one maybe being in the fourth quarter and then continuing into 2025. But it all depends on incoming data. That's what the Fed likes to say, which of course is how we're doing on inflation. And I don't know to what extent we're going to be able to get below 3% and more closer to their target rate, given what's happening in the economy now.
Understandable. And you mentioned, what's happening in the economy. Of course, I have to mention the unfriendly word sometimes. It's a 6-syllable word, geopolitical. So anything, surrounding the geopolitical environment these days, if I can mention a handful of things that many of us are aware of, we've got the Israel-Hamas war, we've got protests going on at our universities, the Russia and Ukraine ongoing war, we've got ex-President Trump's court hearing case, perhaps even the U.S. presidential campaign as it's sneaking up on us too. But most recently, just reading up in the last 2 days, tariff hikes perhaps announced for Chinese EV and numerous other Chinese goods. I know it's a lot to put out there, but how do you feel many of these events are going to affect what it is that we need to achieve this year?
Well, some of these events certainly are contributing to inflationary pressures. Others are not. I don't know to what extent the protests are. They're certainly a problem and they're big news, but they're really not big enough issue to be really affecting the economy much. But other things that you've mentioned, like all the expenditures that we're making towards Ukraine, 61 more billion going that way, and then money going into to Israel. Certainly, we want to be helpful, but at the same time, congressional spending is runaway. We all know it. Federal debt keeps rising. We're at all-time record highs in terms of pace of creating debt. And now with interest rates so high that one of the biggest line items in the budget, the federal budget now, is interest payments. So that's just continuing to exacerbate the debt levels, which is more expenditure in the economy that we don't really need. We don't need all this congressional expenditure that is really helping to drive up inflation. That, and together with the tight labor markets, which is causing wage increases. So some of these minimum wage increases that we're seeing in California aren't helping either, because they're driving up wages. So there's a lot of things that are working against the deflationary trend, and certainly you've mentioned some of them, and I've just talked about some of them. So they're not helpful at all.
Yeah. Yeah, I mean, they're always at top of mind, and I tend to think as soon as I hear some of these activities going on around the world, I immediately go to supply chains, potential crises, right? So disruptions in the supply chain, and thinking of the global down to here in the U.S., perhaps even in Santa Clarita. What's your thoughts on how the supply chains might be impacted by some of these similar events?
To date, they have not been. In fact, we're seeing more of a normalization of the supply chain since the pandemic. Largely, they've become normalized. But you raise a good point. We we have a lot of issues that could easily start obstructing the supply chains again, and particularly, China and Taiwan hostilities, and certainly hostilities between the U.S. and Iran and Russia. And now we have a lot of issues in the Middle East that we have to contend with. So and just think about this, because I'm doing a lot of work regarding new development in California and in the United States, for that matter, which is a driving economic engine for the economy right now, particularly in California. Well, building materials to construct non-residential buildings, which is a big development issue right now, big development driver. Commercial, industrial buildings, large hospitals, large infrastructure projects. I mean, what do we need? We need concrete to create cement. We need steel, right? We need steel rebar, and we need lumber. We need a lot of these issues. Who is the biggest producer of steel? China. Who is the biggest producer of concrete? China. So, and China is also a big producer of lumber and plywood, but fortunately we are too, so we're not going to have to worry about that one. But so those are vulnerabilities that we have if China, Taiwan, or China other become problematic in the geopolitical economy today. So we're watching that very carefully. So supply chains can be disrupted, and that would be very disruptive, of course, to our development environment here.
Right, right. Too, in big picture, as far as workforce goes, there are many layoffs in the recent news announced, and not necessarily tied to anything we've talked about thus far, but perhaps there might be companies who may be looking a little bit into the future and considering some of these external factors, how they might affect their workforce. But recently Peloton, with 15% of their workforce, the first week of May was announced. Google, with 200 of their employees, these folks were considered their core group, being replaced by the India and Mexico labor force markets. So what should we expect as we see signs of these types of companies making changes as it relates to the cost of labor, perhaps even considering some of the external factors that we talked about. But how can this impact our local economy here in Santa Clarita?
Well, I don't know that, certainly these are high profile companies. And Peloton, of course, they had a big run up during the pandemic. So I think this is just a correction as a result of all the demand that came out for that product, and now it's sort of abating. Google overhired as well, and now they're correcting downward. And certainly, we are seeing more high-profile layoffs like this. But in the aggregate, I'm really not seeing a huge run-up in overall layoffs right now. So I don't think we so much have to worry about that, but we do know that the labor markets are starting to soften more. Fewer people are quitting. That period of the great resignation that occurred in 2021, 2022 is now ending. We have fewer job openings now available to be filled than we did back in 2019, and we had been above that level all this time up to this year. So again, labor markets are starting to settle down. I don't think that unless the economy slows a lot more than we anticipate, I don't think we're going to see much of a labor market reaction. Certainly, we're going to continue to see a little bit more softening. The unemployment rate is going to rise a little bit, but I don't think it's ever going to be a real problem, simply because the labor force, both in the Santa Clarita Valley, California, and in the United States, is just not growing that fast anymore. And so we need workers badly. And they're the limiting factor on employment rather than demand right now. The layoffs that we're getting, uh, that we're seeing, are not really, as I said, rising much. And a lot of these people get rehired pretty much at another company pretty quickly, particularly if they have skills.
Okay. Most recently, here in the last month or so, we had one of our big local job fairs. College of the Canyons, Santa Clarita Valley Economic Development Corporation, the Santa Clarita Chamber of Commerce, just to name a few of the partners, City of Santa Clarita, of course, involved too. We had over 800 visitors, perhaps applying for new jobs, I'll call it that, which is pretty phenomenal because in the past year, two separate job fairs in a row, we had just about 600 people apply for or show up at one of these job fairs, and here we are at 800 plus. I'm not sure how to read into that. Do you have any ideas of what could be occurring? And the same number of employers, by the way, represented about 100, 110, 120 employers across the board in 2023, as well as this first quarter of 2024. But job fair attendees quite a bit higher.
Yeah. And we're seeing that at a lot of job fairs. That is quite a bit higher, but again, it's not substantially higher. And yes, so what we're seeing is we're seeing a lot more of the two worker households. One of them had dropped out during the pandemic. They stayed out of the labor force. Now they're starting to trickle back in because as inflation becomes problematic and it's harder to afford as many goods as you had before at these higher prices, the second worker household is starting to come back into the labor force and try to get additional jobs in order to advance household income. So again, that is a scenario that we're seeing. So that goes to show to the fact that the labor markets are slowing down and that people are trying to beef up household incomes by getting second jobs.
Interesting to think of those second jobs in mind and how that might affect perhaps a residential move. I know in the housing market, I was reading up on one of your latest economic forecast updates. We were somewhere here in the valley at about 890,000 for single family homes as an average. Going back to, that might have been February 2023, so just a couple months ago. What's the outlook on the residential medium home price as well as the general single family detached homes, perhaps for the rest of the year? Any indicators on that?
Well, I don't, as long as interest rates stay high, nobody really wants to sell their house and double their mortgage rate on a new mortgage. So it's not likely that things are going to change until we start to see the interest rate environment switch off. But nevertheless, we have this dearth in inventory because nobody wants to sell their house. So just the supply, just the simple fundamental supply and demand elements are going to cause prices probably to stay high, if not rise a little bit higher. You're not going to see many sales. But what we're seeing, of course, is the new residential housing market come in and substitute in inventory for the existing home market, because developers and builders, they can do mortgage buy downs in order to reduce mortgage rates in a subsidized fashion for new home buyers. And so they're doing that. So look for the existing home market to pretty much stay where it is. Housing prices are probably not going to go down anymore. So if you're waiting to jump in with into a housing market with lower prices, that's probably not going to happen, at least not now. Not until some new inventory comes online. We don't expect that to be the case until 2025 and beyond, because again, interest rate environment. So not much change in the existing home market, Jay.
Okay. And then moving over to the commercial side, realizing we've got the industrial space, we still have office space with a high vacancy, needless to say. Just want some general comments from you as far as the immediate outlook on some of the availability in the industrial area, as well as perhaps some hope down the road for some office usage.
Well, the labor market seems to still be creating office using jobs. Trouble is, they're not using the office. So, and Santa Clarita has a real high rate of vacancy or availability of its office space. But then again, so does everybody else that we're seeing, particularly in the larger metro areas of California. So it's not like there's any unique situation occurring regionally. So I don't know that I'm going to see much difference in that this year. I think the hybrid office behavior of employees or the remote is here to stay, at least for the moment. I think that will change over time, and so and I think that office will grow a little bit cheaper here in terms of being able to lease or sell, and so you're going to see people come in and take advantage of that by buying up more office buildings and companies leasing more space. So things will tend to go in cycles. I don't think that the end of the office market is here. I just think we're in a cyclical situation. Things will revert back. I think we continue, because we're not building any office hardly anywhere now, that just the simple organic growth of companies, even if they maintain a hybrid or remote employee structure within the company, they're still going to grow, and more people are going to need office space, and therefore it's going to ultimately be absorbed. So I think this is a temporary situation. It's painful, yes, I understand, but nevertheless, I think it will reconcile itself. Industrial, we don't have enough. We need to build more.
Absolutely. Thinking of one specific industry that most recently has had some challenges, and it looks like perhaps they're up for some more, the film industry. What are your thoughts about the fact that we were at about 133 permits in Q4 of 2023 for the fiscal year thus far? So it looks like there was hopes as compared to the fiscal year prior of 199 permits for the entire fiscal year. But on the horizon, it seems like there might be some more. Let's just call it unproductivity going on here because of the inability to work, right, with the strikes that are potentially coming our way. What are your thoughts about the film industry in general, at least going through this fiscal year, so finishing up 2024?
Well, we watched the Writer and Actors Guild strikes with a lot of interest back in the summer. Going into the fall, they were both reconciled in the fall, I think October and November, and so we thought everything would come back to normal and everything would resume, but it has not, as you correctly point out. So we're not seeing the same employment levels. We're not seeing the same amount of activity in the film and sound recording area. It's a little bit disconcerting right now. As economists, we're wondering if a structural change hasn't occurred, and that we will likely see less activity in this area for a while. So that's something that may be what's going on until we see a pickup in an activity. So the permits that you're seeing fewer of, that's happening all over California. So there's going to be more permits, more filming out of state, out of country. A lot of it will be done in more local locations. I think Santa Clarita will still benefit, but that hasn't picked up quite yet. So this is something that I think it's lagging from the strike, and perhaps there's some structural changes that are occurring because of the costs that are indicative of California.
Well, as always, Dr. Schniepp, you've been a wealth of information. You've offered so much. Thinking of your organization, California Economic Forecast, and of course, you leading the charge there, we're always glad to have you. We look forward to reconnecting again for our next update, perhaps 3 months down the road. But final thoughts for us, and you always are a straight shooter. We appreciate that. But whether it's hope or gleam, however you look at it, what words would you like to leave us with?
Well, other than the weakness that we're seeing in the office market, which again, I think is just temporary, and will ultimately cycle back to where we were, the Santa Clarita Valley economy is still quite strong. I mean, new development is occurring at a pretty good pace right now. The retail markets are doing just fine. Everybody is essentially employed. And entertainment, I've noticed, and recreation is way up in terms of jobs that have been filled, and jobs that will probably continue to be filled going forward. So I look for tourism to still be strong this summer. So I think that's going to be a big deal. And as we go towards the election, I think there'll be a change in mood and attitude. So that could bring a whole new amount of euphoria or vibrancy, to many areas of the nation, including this region. So we'll see what happens. But again, I'm very optimistic about the area. It's one of the fastest growing places in California right now.
Very well put. Thank you for those final words. Again, this is Jey Wagner. I'm joined here by Dr. Mark Schniepp from the California Economic Forecast. And this is Santa Clarita Valley Means Business with the Santa Clarita Valley Economic Development Corporation. We'll see you next time.